Stanford University.
Welcome to the second to the last WE380 of fall 2010-2011. Next week we're off for Thanksgiving. That's a good time if you're taking the class to catch up with lectures and get your reviews in. The talk after Thanksgiving is about modeling physiology for better experiments and so on. Engineering is the intelligent application of resources to problems. And money is one of the most important resources.
Well done.
And it's one that doesn't get enough play over in the engineering curricula. And by the way, history of business schools, it was originally designed to teach engineers how to be managers. So it can't be that tough if they thought they'd do it in a year or two. We can say that at Stanford because the big businesses come out of engineering, not out of biz school. Venture capital is of specific interest to us, but most of the knowledge that we have as technologists is, to put it nicely, lore. It's made up, it's passed from person to person, it never really had any decent basis, etc. And it turns out, well, fortunately, I guess, it turns out that ignorance is also true on the side of the people who give them money, which, okay, well, that's weird. Today's talk by William Janeway is mostly about the investor side, what they've gotten for their money and how they could have perhaps done a better job, because it turns out that sometimes past performance does actually correlate with future return. But this is important to us because while the money comes from their side, the returns come from our side, and we really have to pick winners. It matters a whole lot to us because venture capital is not about taking risk, it's about understanding the actual risks when everybody else doesn't. And by the way, today's talk is different in that we're going to end on time. So off in TV land, you probably won't miss something really, really, really cool, just something moderately cool.
I'm delighted to be here. I will take 1 or 2 minutes to say that the attribute, the hyphenated attribute that's up on the slide was given to me about 25 years ago by an economist named Chaim Minsky, whose work has been rediscovered the hard way over the last 3 years. I left Cambridge University 40 years ago with a doctorate in economics and a clear conviction that I was not capable temperamentally to teach the Keynesian economics that, as Joan Robinson, one of the Cambridge economists I knew well, referred to as bastard Keynesianism. They'd taken Keynes's brand and left the economics behind. I was sufficiently immersed in Keynes's economics, the economics that begins with the requirement, like it or not, of having to make decisions under conditions of fundamental ignorance, not measurable, manageable, monitorable degrees, distributions of risk, that I stumbled out of academia into a world of Wall Street so extraordinarily, inconceivably different from what's emerged in the last 25 years, that I had the chance to try various apprenticeships. And the one that took was, as has been suggested by Andy, the one that took was that which led me into venture capital, and particularly into investing a little bit this side of the frontier of invention in what came to be called information technology. 35 years later, I retired as vice chairman at Warburg Pincus. Along the way, in particular, out here, I played a role, and my firm had played the sole funding role in the creation of, among other things, half of Veritas software and all of BEA systems. And I retired from Warburg Pincus and returned to academia, where my research work has been on venture capital returns, the distribution of them and their dependencies. This lecture falls into two pieces. The first is data and analysis. It's empirically rooted. It reflects the research I've done over the last several years. And at the end of it, you'll see there's a bibliography which includes where this work can be found in the journals, along with a variety of other relevant pieces of work. So the first half is, as I say, it's analysis of factual data. The second part is speculation. And to get to that, the first part really relates to the first three of these stylized facts, these canonical facts about venture capital. There's extraordinary skew, amazing skew in the returns. There is persistence. This is the one asset class where managers show persistence in their results over time. There is, and this is the real focus of the research I'm going to be showing you, that is, this is the contribution that my collaborator and I have made, is to illustrate not just the dependence of venture capital returns on the equity markets as a whole, but very specifically on the state of the market for initial public offerings. Anecdotally, we all knew that, you know? That's the intuition, that's the experience. It's nice to actually be able to show it, you know? I appreciate that I'm in an engineering department. But then the fourth fact, however, the fourth fact is one that has really intrigued me. It's intrigued me for, well over 30 years. And it is the case, I do believe, although very little work has been done on this academically, that venture capitalists have been successful in commercializing innovation across a relatively very small segment of the spectrum of invention. So I'm going to approach that in the second half with questions. And maybe some of the questions will generate some discussion that will be helpful to me, because I think there's a research program that will begin with those questions. Okay, so let's start with the returns. This is kind of what I've just said. This is just tells you what data I'm going to be showing you. And here we go. This is why I need a laser pointer. So this is our data, my collaborators and my data. It's drawn from two limited partners who have been active investors in venture capital funds since 1980. It's 205 funds, which have the following cross-sectional distribution of returns. Okay, so mean and median and standard deviation. Top decile. Okay? Everybody but the top decile. When I say skew, I mean skew. Okay? Even the top quintile is so far up there. But it drops off. It drops off after the top 20. It's really probably the top 15 of these funds. These are two guys who got into venture very early, so you can imagine some of the canonical names. We don't know the funds, by the way. Anonymity was enforced. So incredible skew. I'm going to jump forward and then come back. This is the persistence. Fund 1 predicts Fund 2 to a useful amount. Okay? There's another paper. There's a very good paper by Kaplan and Shore, which shows they have a much larger data set. They're the only time anybody was ever allowed into the NVCA dated weighted cash flows. And they showed 2 funds forward. You get some serious statistical prediction. But then let's go back here. Now there's a second thing. When you look at this and you start doing a little time series work, it looks like something's going on here. Are American venture capitalists getting better at their job? Right? It looks like, this quinquennium, each one gets better and better. Or is there something else going on? Okay. This is a methodology that Steve Kaplan and Antoinette Shore at Chicago and MIT respectively worked out, which we applied to our data. So this is not an original methodology. The notion is that for each of the funds, we got their dated cash flows from the limited partner to the fund, from the fund back to the limited partner. Every time each fund called the limited partner, we put the same amount of money into the NASDAQ index. Every time a distribution came back, we took it out of the index. Okay? We have what we call the public market equivalent. The median fund. Oh, by the way, our funds, our 200 funds, are 1.5 to 2 times better than the industry. In terms of, that's pulled up by the top decile, of course. So for our superior funds, the median fund gave you exactly what you would have gotten by just investing in the index with complete liquidity. This is after fees, of course. This is after fees and carry. Because this is the cash back to the limited. Knock off the top decile and the average one, the average fund, the average return is sitting right with the index. So there is a correlation between venture fund returns and the state of the public equity markets. Just to carry it to a little bit of an extreme, this is not quite as detailed, as rigorous a methodology, but we took our funds because our funds ran up through 2005, so we could look at the bubble and just look at the impact of the bubble. So bubble funds are funds where more than half of the distributions were made during the ultra-hot quarters that constituted the bubble. I'll come back to what just ultra-hot means. That's actually a statistically significant term in our methodology. And then the post-bubble funds are where they blew it. They missed. More than half of the distributions came after, right? So the statistics, this is the cash multiple, this is the IRR. I mean, the 25th percentile fund returned almost 3 times cash if they got out in the bubble. This is what happened. This is what happened if you missed it. When they rang the bell, you were still saying, hey, this is the new world and it's going to be like this is the new normal. The new normal is NASDAQ 5000. So again, this is just this is more anecdotal than really rigorously statistical. But now we're going to get, this is our contribution, okay? This is where we're looking at the performance of the funds relative, not just to the public, the NASDAQ market as a whole, which includes Microsoft, We're looking at it relative to the market for initial public offerings. So we took, for each quarter, beginning on the first quarter of 1980, we counted the number of venture-backed IPOs. And when you did the sample across the time, it fell into some very neat buckets. One standard deviation from the mean of IPOs per quarter is 20. One above is 40. So that made it simple. We said there were 20 to 40 venture-backed IPOs. That's a normal IPO market. If there are less than 20 per quarter, that's a lousy IPO market. There's more than 40 per quarter, that's a hot market. But then we also had to take account of the bubble. So we said, more or less arbitrarily, if there are more than 40 IPOs, and by going into the various databases, we could determine that more than half of the IPOs were for companies that were not yet profitable. Then we call that an ultra hot, super hot. Those are the bubble quarters. There aren't that many of them, as you can imagine. Now, That was step one. Step two, remember we have the dated cash flows to and from our funds. So we did a weighted cash flow in, weighted by the score we gave each quarter in which money went in. 1 is poor, 2 is normal, 3 is hot, 4 is ultra hot. And then when the money came back out, we did the same exercise. So for each fund, we have an index of relative hotness of IPO market as the money went in, relative hotness as it came out. So we have a market conditions index where, up here, where if the index, if you take the exit minus entry, right? So if the market's hotter going in than coming out, the max you could get, that would be minus, less than -1, right? That means you're investing with the wind in your face, right? The best you can hope is above 1. It would be if all of your exits were in the bubble, and so you had a 4, and all of your entry had been in poor market conditions, which really probably wouldn't work given the way the time pattern. But the max you could get would be +3. The worst you could get would be -3. Well, after all that, turns out this doesn't really tell you much. Normal market conditions, in other words, between +1 and -1, yeah, the group did better than when the market conditions index was most favorable. But what that's telling you, frankly, what it's telling you is that the conditions when you invest don't really matter very much. There's a lot of academic literature about how if there's a hot IPO market, the venture guys have to pay up, the valuations go up, and that's going to penalize them. The fact is, exit conditions completely dominate. In other words, if I pay twice as much for something that fails, right, it doesn't really matter. If I pay twice as much, twice too much for going in for Google, doesn't matter either. Or as we say, there's a technical term in the venture capital industry, good enough is good enough. So the exit conditions really have an extraordinary impact on venture capital returns. And what that tells you is that the evolution of the IPO market, if you want to read where the venture capital industry as an industry is, you really should begin with tracking the state of the IPO market. Again, everybody in the business knows this, but it's kind of nice to see it actually demonstrated. By the way, we took out the top decile. This is all the same calculations without the top decile. And here, what's interesting, again, with the exit conditions, doesn't matter. You get virtually the same, 76% median, 69% median IRR, right? What does that tell you? Everyone's a genius in a bull market. So let's look at the history of the IPO market in the United States since 1980. Now this takes it down to 2007. We're going to bring it up to date in the couple of slides further on. First thing to note is $1 in 1980 was about $2.50 in 2007, just on the CPI, nothing very sophisticated. What you see here is that all of these time series cycle. The number of IPOs back in 82, 83, when the IPO market opened up for the first time in a decade, we thought that was a bubble. Boy, we didn't know anything. This 86 was a really nice vintage year. Microsoft, Oracle, Sun. Pretty important year for Stanford. This was what people kind of started getting used to, running up into the bubble. 97 actually was a surprisingly poor year. What was different about the bubble was not the number of IPOs. It was the offer amount, what happened over here. This is the one, this column is the one that's really very interesting because something happened structurally. this, let's say around here, 25 million in current dollars was what you needed to justify an IPO. That's, get bankers, and it paid for itself, and it was worth doing. In the bubble, it got up to, it doubled. It doubled very rapidly. And then when the bubble burst, it didn't go back. It didn't go back. Now, we can speculate, because there hasn't really been any really rigorous work on this. We know that the guys who sold out in the bubble were not just smart, timely entrepreneurs and VCs. They were also the guys who took them public. All of the four horsemen sold their firms to big firms. Tom Siebel did it 3 times. There clearly has been an institutional transformation. Along a variety of other things happened. Sell-side investment research went from being a public good to being a private asset when it became clear that back up here, people actually got paid for being sell-side research analysts just for doing research. As brokerage commissions came down, 2 things happened. One set of sell-side analysts went to the buy side. They became smart money managers doing their own work. So their work became a private asset. The other set realized that they weren't going to get paid by brokerage, they had to get paid by corporate finance. Back up in 1985, in my prior life at the firm which I joined after I joined Warburg Pincus, whose core asset was fundamental investment research, we looked at the world then and said there are 2 paths forward for fundamental research: commoditization or prostitution. Not necessarily mutually inconsistent, but we didn't think we'd be good at either of them, so we sold our firm, which is what got me to Warburg Pincus, so I'm delighted with that. But what happened here is sell-side investment research is basically a joke. I mean, it's 4 bullet points, some spreadsheets generated in India by kids who couldn't get into the IIT. But the point here is this cycling back to a poor IPO market, we're going to go into some detail on this, has still gone with a very high threshold. And if you do a back-of-the-envelope calculus and figure typically a company going public will sell order of magnitude 15 to 20% of its shares, and it has to be a $70 million, $80 million deal. That means a market value implicitly of 350, 400 million. If startup company to get there, it's going to be valued at 3, maybe 4 times revenues. It means it has to be a $100 million company to go public. That's the net of all this that's on this slide. Now, this brings it up to date. The first thing I would call your attention to is the state of the IPO market. Remember I said 20 was the threshold of normal? Less than 20 per quarter? This has been a really tough environment. It's come back a bit. There's a big pipeline. It's come back a bit, but look at still the threshold for getting out. And I don't have the median year on this because there was just about enough stuff to get on this.
Did it continue to go up?
Yeah, it's way up. It's 9 years. So you think about what that does to the IRR, even if you get public. And public isn't liquid. Public isn't out. So it remains a very difficult environment.
A question on your previous slide before that one, though.
Yeah.
The big thing here is this is the year here where some sectors outside the valley would say this is when the recession began.
Which
we
year?
would say it was 87, 88. That was the year the bottom dropped out in October, and people were starting to say things like October surprises. And then it was only after that time, this time up to the when the bubble burst. That was when people were discovering computers, communication technology, the internet, and the like. In that period of time, the web beginning at 90. But I know people who have actually been unemployed since 88, actually, and how they live, I am totally.
Well, I have to tell you, one of my partners this morning was jogging through Golden Gate Park, and he saw a homeless guy with a T-shirt. T-shirt said, Web 2.0, 2010. That's the fastest cycling. That's the opposite of yours. There were guys. There were guys. I have to tell you, there were guys who knew how to program in 360 assembler who never adapted. Right. But that's not what we're really seeing in all of this. I mean, you're right. The waves of technology that came through here. But back in the early 80s, I mean, that's Apple went public in December 1980, and I think there may be a bigger secular story, which we're going to come to in the speculative end of this talk.
Well, see, I think the big thing in the 87, 88 timeframe is that's when the bottom
No,
probably dropped out of Detroit. I would say if you went to Detroit.
Yeah, but venture guys weren't back. This is venture-backed IPOs. This is that. Frankly, it's completely irrelevant. I mean, let me be polite.
Right.
Shut up. So, moving right along, standing back. This is gross simplification, profile of the U.S. venture capital, quote, industry, unquote, over the last 30 years. Okay? Now, again, remember, this is 10 billion. It's 5 billion. It's 2.5 times, right? What basically this is saying is that for 15 years, member firms of the National Venture Capital Association were raising on the order of 10 billion of current dollars, 10 to 12 billion of current dollars. And then this happened. I mean, a decimal order of magnitude. What is that? That is the state pension funds. The dumbest institutional investors in North America, not in the world. Have you ever met the German Landesbank? They were the guys who bought the subprime CDO squared trash tranches, which the state pension funds in this country actually did not. There's a very interesting paper. I didn't put it in the bibliography, but it's got one of the great titles of any paper published in the Journal of Finance. It's called Smart Institutions, Foolish Choices. And it's a detailed analysis of returns from investing in venture capital by type of investor. And by the way, you may not be surprised to know the one category of institutional limited partner that has done consistently well, university endowments. There you go. Particularly when they stopped giving money to every alumnus who started the fund, which was a little problem not so far from here for a while. So the point here, of course, is that, I'm sorry. Yeah.
Was that money ever called?
Oh, yeah. It was spent.
It was all dumb.
It was spent. I could put this up as money invested.
It was all lost.
Yeah, so is this commitments or costs?
This is commitments. These are commitments to funds, but it trails. Look, I mean, I could have put up. It lags 2 years as to when it was invested.
But they didn't manage to call all that money, even though the world had fallen out.
Absolutely.
What a deal.
Well, because remember, the way a venture fund is set up, you have a 4-year investment period. If you don't take the money, guess what happens to your management fee?
Well, no,
It does.
If you don't deliver the money.
No, if you don't call the money,
Right.
then you're not within 4 years, and you can only call it if you're investing it.
Yeah.
Then your management fee will go from order of magnitude 2% to 1/4%.
But the person on the other side is having to deliver the money on the call.
Well, Harvard in the winter of 2008-9, decided it wasn't going to do that. So instead, they sold their commitments. In other words, the put options they'd written to private equity for some number that has never been released, but was a fraction of the nominal value to one of the secondary, quite successful buyers of positions. So, but I promise you, this money was, this money was invested. Now, but the other factor over here, and this is, I think, is what it's really created the challenge for venture capitalists. Writ large, it's going from being responsible for 20 to 30 billion to being responsible for more than 200 billion in 10 years, right? Guys who had learned how, over 20 years, to invest 20 million, going to 50 million, going to 100 million, we're all of a sudden supposed to invest 10 times the amount. Now, you all recall that some guys who'd raised really big funds gave some portion of it back. But the fact is, when you go from having a $2 million management fee per year to a $20 million management fee per year, and you have the same number of partners, it's kind of hard to give the money back. So most people didn't. And we're going to discuss in the speculative section different responses to that situation. The point I would really make is that when you take the data on the IPO market, this is still, I would say, in the analysis rather than the speculative part of this talk, take the data on the IPO market, and you take this, the radically reduced commitments to the sector, this, the funds under management, are going to decline. Capital is being withdrawn from this sector. Will it go all the way back to here? Who knows? But it's clearly going to continue to decline for some period of time. It took the state pension funds 20 years to be convinced that they had to invest in venture capital as an alternative, independent asset class. It's taken them 10 years to work out that it's not an independent asset class, that it's one that gives them poor returns at very high fees, and they're going away. So this is likely to continue. Now, let's see. And by the way, this sort of is what nails it. In the last 2 quarters, the 10-year return on venture capital has been negative for the first time ever. Yeah. And, it's of the nature of things. It couldn't catch the bounce in NASDAQ over the last year. So that is the final data slide. Now, as Vladimir Ilyich Ulyanov said, or asked, what is to be done? The first thing to say is that even if the venture capital industry as an industry was probably a kind of category error, it is important to say there have always been venture capitalists. Antonio, in The Merchant of Venice, was a venture capitalist. He put out money to fund 5 high-risk ventures. He diversified, very rationally. He'd studied CAPM. He diversified his portfolio. Each ship goes to a different destination, loses them all, and he happens to have a really tough limited partner called Shylock, who, wants his bond. But there will be venture capitalists. Alexander Graham Bell got financed. Stevenson, with the railroad, the first locomotive, got financed. There will be venture capitalists. Some of them may be called angels. Some of them may be super angels. Some of them will be members of the National Venture Capital Association. They will be professional managed limited partnerships. Just not going to be remotely at the scale of what it's been. And my throwaway line here is that to think about the industry means thinking about it coupled to the extraordinary phenomenon that began in roughly 81, 82, after Volcker had broken the back of inflation. That 20-year run is the greatest bull run in equity markets in the history of capitalism ever, anywhere. It is not likely to recur in any of even the, where are the students? Even in your lifetimes. Now, that doesn't mean there isn't an economic role for venture capitalists. There clearly is. And this is where we're going to start switching gears a little bit. The biotech industry as an industry exists because of venture capitalists funding distributed research and development for big companies. Happened, and I'm going to talk about it, that's one of the only sectors where it proved possible to get returns from the public market without creating self-sustaining cash-generative businesses. But more generally, the Cisco phenomenon, feeding the Cisco acquisition engine is a valid economic role. Similarly, given the world of the web and the world of open source, generating a raft of lightweight startups that don't take a lot of capital, where you can, instead of figuring, you got to have 10% of your deals be winners in order to justify your existence, maybe 1 or 5% will be enough. And you can shoot the others because you're putting very little money in. Of course, the guys up there are going to be able to start these things with their own credit cards without even needing their parents' credit cards, given how cheap it is. Even so, I would argue that at 170 billion under management by members of the National Venture Capital Association, the, quote, venture capital industry is still way overcapitalized relative to its economic role. From the point of view of the general partner of a venture fund, what is to be done? Well, one thing you could do if you're running $1 billion fund and you know how to run a fund with 20 positions, given the scope, is you can find some black holes, right? Alternative energy. That'll chew up your capital pretty fast. Alternatively, you can retreat. And a number of people we know, either they refused to raise big funds because they knew what they were good at, some of the old timers, or they had one big fund and they've stepped way back, and they're a fund that scaled to the kinds of opportunities that do exist within the scope of where venture capital has been successful. The third alternative is really for the entrepreneur as much as for the venture fund. And that is, because of the experience from 1980 on, 1982 on perhaps, the default premise on starting a company has been success means going public, having independent business, and realizing our return through distributions or sales into a public market. What I'm suggesting is that in the environment we're in now and going forward, the default premise rationally should be not whether, but when do I sell? So the A round buys you a product out of a concept. One of my old partners used to say, when I'd tell him about something we were working on, he said, when they plugged it in, did it light up? So if it does, do you hold the auction now? The B round is supposed to get you, 3 customers who will raise their hands and say, I paid real money for this, and I do it again. It works, it created value. Do you hold the auction then? Or do you really decide to roll the dice and spend the big bucks? The big bucks are almost inevitably around building channel, building brand identity, building customer service and support. Or do you turn the project over to people who already have all that stuff? Big established companies who buy things. So, that's part one. Now let's speculate. The speculation is really about this, where has venture capital been successful and why? Well, we know it's been, overwhelmingly focused on ICT, secondarily on biotech. Here's some data from the NVCA. So ICT, which is a put together of 7, 8 industry sectors, and the content obviously varies, has varied substantially over 30 years. But it's 50 to 75% in each of the, instead of doing cumulative, frankly, I was doing this before catching a plane. I pulled these years, which are not necessarily, they're not unrepresentative when you scan all the annual data. Interestingly enough, biotech has been increasing. It's also stayed high post-2000 when everything else came way down. So the model of investing in biotech into big pharma and still having access to the public equity markets, this is an interesting phenomenon. But all other, this is the law of small numbers. Out here, where some real money starts to get invested, never more than 20%, and that includes everything. That's retail, that's business services. It is a very broad range. It's energy is in there. So Let's talk about ICT. And this is something I've really came to in trying to think through the triple relationship, the interaction, the three-body problem of the state, the government, the market economy, and financial capital, people with money to invest who have choices about what to do with it. And there's some recent work. There's a new book out, a book of essays edited by a guy called Fred Block. You'll see it in the bibliography, called State of Innovation, which is the last 30 years of government investment in science. There's a lot more work, of course, on the post-war world, that whereas my partner Henry Crisell has written a couple of books and was a seriously successful scientist. He was one of the people who enabled fiber optics, and a seriously successful venture capitalist at Warburg Pincus. In the early years, the real visionaries were in the Defense Department, the technical visionaries. And this is a number that I had not appreciated. For 25 years, from the Korean War right through into the 70s, into the late 70s, more than half of all R&D spending in the United States was conducted by the public sector. What that, and you guys know better than I do, all of the spillovers. By the way, it was done, there's a very interesting article here, which is in a book of essays that's in the bibliography. One of the characteristics of the world that DARPA was relatively late to this party, but the world of the Office of Naval Research, the SAGE program, very loose intellectual property regime. And of course, as a customer, the military required second source. So AT&T put TI into the semiconductor business when it was clear that gallium arsenide just wasn't tractable. TI educated IBM how to make silicon, how to process silicon. It's unthinkable today. But we're thinking about as to what were critical enablers of the digital revolution. In biotech, of course, we do have the NIH. Did I miss a slide here? You know? No, we didn't. I summarized it all in one. We had the NIH doing the science. The difference for venture capitalists, and this is a very critical difference between ICT investing and biotech investing. In the case of ICT, by and large, partly because venture capitalists have been standing on this platform that was built with government money. At startup, you can envision how, within the life of your fund, what you're launching is going to turn into a business that generates positive cash flow. If there isn't an IPO market, fine, we'll wait. If I'm dealing with a trade buyer, fine, I have an outside option. I can just stay independent and keep making money. This is not true in biotech, right? In biotech, the time to positive cash flow basically is incalculable. In fact, Gary Pisano, this is the book Science Business, which is sort of the accumulation of data. You may disagree with some of his interpretations, but the data through 2005, all public biotech companies, and virtually by definition, all private biotech companies are losing money. The cumulative return, cash return on all the investment, was positive because of Amgen. And there was a further factor, which is that the first generation, Genentech, Biogen, were doing a kind of life science which was radically easier to go from the lab to the clinic, because what they were doing was taking a known molecule, insulin, right, human growth hormone, and just producing it in a different way. So they didn't have to worry about side effects. They knew what the side effects were. The evolution had taken a couple of 100 million years to evolve what the side effects were going to be. Radically different in more innovative approaches. But the VC returns from biotech are roughly comparable with the VC returns from ICT, and that's entirely because of this factor. And in fact, the proportion of all the IPOs in '04 through '07, when the market was dead for biotech, was far higher than it had ever been before. That's something, as I say, this is the speculative question I see. Why would that be? Now we have a sort of general answer, which is a kind of behavioral finance answer. People look at the returns and they don't look at the mean and they don't look at the standard deviation, they look at the right-hand tail. I put this some time ago in a talk where, you know, you have an investor who hears about some drug that has just been approved and that goes from, you know, to $1 billion of revenue per year immediately. And they're looking at the next one, and the next one's in phase 3 clinicals. So they say, well, there are two possible states of the world. One, it's safe and efficacious, and we make $1 gazillion. Two, it fails and we lose everything. You know, $500 million sounds pretty good to me. Pisano puts it a little more, how shall I put it, diplomatically. So, but let's talk about the other sectors. I'm sorry, Andy.
Biotech, that's also true of airlines, according to Warren Buffett.
The net return on all investment in airlines is a very large negative number, except where the market's rigged, Singapore. Right, we have a local monopoly in a desired destination.
So this may be the natural state of the market that investors always get fleeced?
Well, the fact is, though, you've got these other sectors. Let's talk about nanotech. I got into a big fight with some scholars some years ago who were working, their work is in Naomi Lamoureux and Ken Sokolov's book, who were in 2006, arguing that nanotech was going to follow biotech. I said a really big difference. In other words, it was going to be a great place for venture guys to invest because the universe of applications was limitless. I said, but that's the opposite of biotech. Biotech, you know what you're trying to do. What you're trying to do is save human lives. In nanotech, you don't have to, you know, think about the gray sludge taking over the world. But nanotech is like plastics. So in the firm that I worked in for 15 years, the one we sold in '85, the first of the high-tech industries where we built a fundamental research base was chemicals. Going back to the 30s when the firm was founded, that was the science-based high-tech industry. So when I joined it in 1970 and really got involved with the smart guys in 73, 4, 5, I escaped from the investment bankers, the lesson that had been learned was plastics. You remember The Graduate? You've all seen The Graduate? It took each of General Electric and DuPont $1 billion of roughly 1955, 1960 dollars and 25 years to get commercial uptake for engineered thermoplastics. And then the real boost came because of OPEC, when the auto industry had to take 1,000 pounds out of the weight of a car to meet the fuel efficiency requirement. Not a place for a venture capitalist to play, right? And my take on this is that so much, in materials, the whole point is it's a general purpose material. What's it good for? Having the resources and the time as well as the money as well as the customer base to explore, what are we going to do with Kevlar? Where does Lexan trump aluminum? It takes decades. And getting it qualified, they used to say, this was the old GM, that getting a new material qualified at GM took longer and cost more than getting a molecule through the FDA.
That's a lot.
It's a really, really tough place for venture capitalists. Okay. Now, one of the things that was periodically is a real temptation. The two examples I put up here are lasers and semiconductors. In the 5 years or so after lasing phenomenon was finally demonstrated replicably, because there was this period of time when it was sort of thought maybe this was cold fusion before cold fusion. It was really hard to get it to do what it was supposed to do in a lab other than the lab which had already done it. There were 200 laser companies started in the United States, as many as there were mini computer companies in 1980. By the way, as many as there were automobile companies in 1925. Do you imagine that anyone who started any of those laser companies was thinking about a supermarket checkout counter, let alone a CD player?
There were those who did.
Well, it took 20 years.
20 years.
That's my point. Not a place for a venture capitalist. In fact, we got very much involved. One of the deals that never able to do, which is another story, is a company out here called Spectrophysics. Spectrophysics was a great business. Herb Dwight was a hell of a businessman. It had 4 lines of business. Supermarket checkout counters, systems for farmers to get the fields level or for people doing golf courses. That was the second one. I'm trying to remember the third. I guess the third was scientific instruments. And the fourth was making lasers. They broke even on the instruments. They made good money in agriculture. They made a ton of money in retail. And they lost money making lasers. In fact, the lasers they used in the other 3 businesses all came from Japan. But the founder, it was a sort of tribute to the founder, they had to keep making lasers. So they became an application, a value-added distributor of lasers, and therefore a successful business. There was no other one that really became reliably successful. The superconductivity, I got one of the things I'm really quite extraordinarily proud of is that my colleagues and I at my old firm in 1983 provided the capital that funded the project at UCSF Medical that demonstrated the clinical value of what we then called NMR imaging to distinguish it from NMR spectroscopy. I'm still not aware of any other really profitable, the Large Hadron Collider is not a for-profit enterprise. Yeah, right. Good, I like that. In a way, I think there's a sort of category here which I'm suggesting, which is VCs have no business funding science. Historically, science has been funded in this country in 2 ways. It's been funded by large enterprises that, for a time, it always seems like it'll be forever, are endowed with sufficient monopoly rents, whether by legislation like AT&T, by phenomenal commercial, how shall I put it, aggressiveness, like IBM or Microsoft, or Google today, or by patents like Xerox, right? That's been one source. And as those monopoly rents come under challenge, the investment in science goes away. And it all moves towards applications. And of course, we all know the history of Bell Labs. We all know the history of Xerox PARC, very close to my heart. The other has been government. And venture capitalists properly sit downstream, looking for where inventions can be brought together to create an innovative solution to an identifiable market problem. And the best venture capitalists spend a lot of time, sometimes spend more time worrying about markets than they do about the technology, because there's always so damn much technology. So the last sector I'm going to talk about in specific terms is energy, which really falls into two buckets. The first is, in effect, conventional, which, by the way, ethanol is conventional energy. It's stuff that involves no innovative tech. Everybody knows how to do it. So the cost may vary, but the cost varies in a predictable way relative to the domain. But the first key factor, there are really few, just some very simple key factors. A unit is $1 billion, right? To do anything is $1 billion. To do anything that's really going to make a difference is multiple units. We've got one of our, I think our most successful IPO in the last 6 months was I have to be very careful about, the least polluting tar sands company in Alberta, Meg. And it is phenomenal. They do it all underground. They don't mine, open cast mine, et cetera. I'm sure when you trace it back, they need natural gas to heat the stuff up, but it's underground, so it's a lot less polluting than the real horror stories. Meg is now cash flowing very, very nicely. Got a really nice big public market value. It's $5 billion of risk equity. Well, a good deal of that came from China. Right? And a certain amount of it is debt because you can start funding against the cash flow. But the second factor, and this is true even of a MEG, is you've got a commodity risk that's just different in kind. Yes, semiconductor memory has commodity risk. I guess that's why it's all made by two companies, not in the United States. Oh, I guess Idaho counts as the United States still. But the Aryan nation. But this whole model is just different in kind from what U.S. venture capitalists grew up with. It's been a place for risk equity. That's where the Nobel fortune was put in the Black Sea, in Baku. Rothschilds made a lot of money in oil and gas 100 years ago, and there was a fellow called John D. Rockefeller who made Cleveland the most profitable, and by the way, the most technically innovative city in America at the turn of the end of the 19th century. Green tech, clean tech. For me, the real issue here is you're still exposed to commodity markets, but we don't have the government-funded science technology base on which to dance. We're taking fundamental science risk against the expectation of both government policy and the price of oil and gas. This is a tough place to be playing. And by the way, if you're going to deploy anything, it's still a unit's still $1 billion. And this is, of course, a little disheartening. This is data from the Pew Charitable Trust, who do a G20 clean tech, green tech survey every year. And this is all in. This isn't just, China, of course, it's essentially all government. Their outspending is 2 to 1 with an economy that, if you stretch, is a half of ours. And, we're still not sure whether there's any reason why we should be spending to reduce CO2 emissions, because after all, it's a socialist plot, right? Global warming. What I will say is I think we have to be, I think it was kind of nice symbolically. I think we have a great Secretary of Energy, and I think there's a lot of people who really know what they want to do, but our political, where we are now is we're stuck. I think it is time to go back to the future. My final speculation is that if we're going to get the conditions for venture capital to play the role in the next new economy, the green tech, clean tech economy, that it played in the last one, the digital internet economy, it's going to depend on massive state investment for non-economic purposes, for national security, for the same kinds of reasons that from the state of New York guaranteeing the bonds that funded the Erie Canal to DARPA, and access to speculative liquid markets so that venture capitalists can afford to take the risk, given that they have some chance of winning even if the project fails because they get public and get out. And what's going to give it to us? I don't know. This is my final speculation. The Greenland ice cap goes, and Palm Beach, forget about Bangladesh, it has to be Palm Beach, is under a couple of meters of water, then we may finally get the political response that enables venture capitalists to participate in creating the next new economy. So that is it. The bibliography is on the website. If anybody wants to chat, that's what email was invented for. I don't do Skype. I have books to work. I have to be able to do asynchronous communication over in Cambridge, plus it's 8 hours. We have some time for questions? Yeah. Well, no.
You left one item off that last slide, which was relaxing the IP ownership issue.
That's a good
Without IP
question.
leakage out of the universities and out of the government, this isn't going to work.
You know, it's an interesting question. There's been academic work, and I don't have it all at my fingertips. There's been academic work on the economic consequences of Bayh-Dole, right? The balance of the research that I've read, and I haven't really gone back and looked at what's been done in the last 3 years or so, was that, you know, the methodology suggested there was net gain, but it's not clear to whom. I mean, it's really hard to measure social gain. It's easy to count $500 million to Columbia from the Axel patents, right? So this is truly in the level of, you know, intuition and speculation. Certainly, there is something about translating invention into economically significant commercial deployment that goes with loose property regime. Now, if we take the long view, the United States economy, at least as much as China's, was entirely based on theft of intellectual property, right? So not the Shaker Mill, the mill in Rhode Island, the first mill. Yeah. No. This was way before that. This was in 1780. The Salter Mill, Samuel Salter. Yeah, he didn't actually work for Arkwright. He worked for one of Arkwright's competitors. And at this point in Britain in the 1780s, the law of the land was that if you worked in the textile industry, you couldn't emigrate for 5 years until 5 years after you quit working. He memorized. Yeah, that's right. Unenforceable in California. But in any case, he came to the U.S. and he basically replicated what he'd seen, and that was the first textile mill in the United States that made money, and that became the first wave of the Industrial Revolution. But in any case, the notion of information spillovers, of course, is the whole base of Romer's New Growth Theory. It's to be found in Alfred Marshall, and it doesn't. You can sort of read it into, like so many other things, into Adam Smith, but it is a constant, and I think that it will be a very significant issue with respect to the funding, as and when it ever happens, of this government, of our state. In the technology, in the science and the technologies to generate clean tech, green tech at scale. I think it'll be a very important and challenging issue. One thing that as a customer, and by the way, there was a very interesting article about a month ago, I think it was in the New York Times, the military, guess who is the most sophisticated buyer of advanced clean tech technology in the United States? The military. They're buying all this stuff for Afghanistan, where you can't plug anything in. So you need fuel cells and solar cells. But we're still, we're still however many step functions away from actually meeting cost of using natural gas when you can use it reliably. Yes, sir.
Let's think a little bit more about the internet sector. And with the raising threshold for an IPO and the increase of commoditization for the necessary talent to get a valuable iPhone, valuable internet company, do you think there's where is it going? Is there going to be another $1 billion internet company?
Sure, because there will be, for a very simple reason. This is the law of large numbers, because there are 20,000 of them being started. So no, I'm serious. I am serious. One of the how many failed startups did it take in the bubble to produce one Amazon, one eBay? But now the cost is Amazon could only have been created in the bubble because it was some number, and I've been trying to get it, and nobody will talk about it. But when you look at the total funding for Amazon to get to positive cash flow, it was a couple of billion, easily, including the debt on the warehouses. They had to reconstruct an entirely different logistical infrastructure. But today, when you put something up, I mean, it costs nothing. You can find out if your friends really like it. You can find out if, you can buy a couple of AdWords from Google, and you can fail and not have to drop out of school, right? So no, but I'm serious. The cost of failure is so low, and the universality of the tools in the medium is so complete that whether you're in Hyderabad or Shanghai or Minsk or Cambridge or New Cambridge or Palo Alto, I mean, there's the flood, and some small number of this enormous flood of attempted innovation will catch. So there will be another Facebook. May not be another Google. Remember, the PageRank algorithm was funded by the National Science Foundation. It was a fundamental invention. It was not just a couple of kids getting together and saying, gee, wouldn't it be nice, I'll show you mine if you show me yours. It really took the kind of investment in the development from science into technology that characterizes the really important thing. Yes, sir.
So I noticed a couple things, that the VC industry as a whole is just an invisibly tiny part of the finance industry.
Correct.
And it has a particular structure with funds of a certain size and number of commitments people plan to make. And if there is a big inflation bubble, for example, then those assumptions about how many deals can be done out of the size of a fund, collapse. And do you really think there might not be a VC industry in some sense?
Well, as I say, the National Venture Capital Association, which is just 35 years old, will exist. It won't have as many members. Instead of having whatever it is now, 1,100 or something like that, it may have 300.
But will they look like today's companies, or will they?
I think there will be some that will look. I could name 6 or 10 that somehow managed to kind of stay what they have been while shifting focus. They didn't do any internet investing in 1990. And others that have transformed themselves into completely different, they're already different beasts. I mean, NEA is a different animal from August Capital, right? They're just fundamental. And they're both members of the Warburg Pincus. We still do startups, but it's a $15 billion fund. So it's a different, it always has been a different beast because of the breadth of style of investing that we do. There will be, I think one of the interesting questions, and by the way, this has just begun to attract academic attention. The first disciplined paper by absolutely top-ranked scholars on angel investing is now a working paper at the NBER by Josh Lerner and Antoinette Shore. So the notion, the angel investing is really back to the future. It's those people in Cleveland. There's some really good work by Naomi Lamoureux, who's at Yale, she was at UCLA, and Maggie Levenstein on Cleveland as a case study and how it evolved from when Rockefeller, from when Standard Oil money was spread around the town and to when it failed in the 30s and completely failed. The notion of semi-organized, locally oriented groups of people who can afford to take risk and who learn, they develop some heuristics, some practice. That's clearly happening. I mean, you've got all your different angel groups out here. We have the Cambridge Angels. And that's filling some aspect of this. By and large, I think the corporate venturing has a long history of, every time you think you know all the different ways to fail, they'll find a new one. Usually it's been because they don't know whether they're supposed to be making money or feeding the acquisition machine. The ones that the simple direct focus on learning from Cisco. Whether or not you put any money up, but equipping a group of people to go out there and be searching through the underbrush against a corporate mandate, that makes a lot of sense. That's clearly one path forward. Yes, sir.
IT industry, you believe there will come a new Facebook, but going to the biotech, you believe there will come a new Amgen? Do you think there will come a new Genentech?
Well, as I say, I mean, look, there can be, blockbuster drugs that come out, but it's just so much harder. And the record, I mean, Professor Powell over here, I wouldn't dream of a pine on the biotech industry in his presence. What I can tell you is the intelligent investor today has a reservoir of public biotech companies which have absorbed well north of $100 million of capital from venture capitalists, from corporate partners, and from the public, all of which have a finite time to die against a non-finite, non-specifiable time to get through the FDA. So, selectively coming in at year 10 to 15 from founding to provide the last money to get through the phase 3s against a portfolio of drugs that have been in the works. I mean, that's how Warburg Pincus is investing in biotechnology today. Because the upfront odds are so daunting.
Every promising drug now in all biotech now. And
Well, that's good. I mean, that's good. You're not competing with big pharma. You're trying to get them to buy you. Because big pharma's productivity of research is lousy.
Exactly. But therefore, would you ever see it, Amgen? Would you say that Genentech will not be bought before we come to a state where
I think that's likely the case. I think they will be. I don't disagree with that. By the way, I chose not to invest in Genentech in '77. Wrong. But I did help create a company that sold the molecular tools to all of the biotech companies, and to be quite successful.
So we're going to stop you here because we promised to get you out at 5:30.
Okay.
Thank you so much. It's been a great job.
Thanks, Dennis.
Absolutely stellar.
I'm not
Thank
going to
you.
leave with.
For more, please visit us at stanford.edu.